Hello everyone, welcome back to today's session on business mathematics. Today we'll be taking you guys through inventory valuation. Inventory valuation. So what then is inventory? So inventory here is the amount of stock that a company is having at the end of what? An accounting period. So let's say at the beginning of my business, I had an inventory of what? I had a stock of, let's say, 5,000, and I sell, let's say, 30,000. So I'll be left with 20,000. So the 20,000 here is my what? Inventory. The amount of stock I have at the end of my business or at the end of my accounting period. So that's basically what inventory is. So here is the case that with inventory valuation, you won't be giving the value straightforward. You see here, when I was explaining the inventory, I gave out the value straightforward. But with inventory valuation, they will just give you the amount or the unit. Let's say I have like 20 units left at the end of my accounting period. So that 20 units, I have to value it. So me valuing this 20 units is what we mean by inventory valuation. Okay, so with inventory valuation, we have a lot of techniques we use in valuing our inventory. First, we have average inventory and inventory turnover. Secondly, we have perpetual inventory and universal product code. Third, we have specific identification. There are a lot. We have FIFO method, LIFO, gross profit method, we have retail method, a lot of method or techniques. So let's start with what? Perpetual inventory valuation. So you could see that when you go to a grocery store or any mall, you will see that at the end of that product, you see at the back of that product that you will buy, you will see something like, you see a lot of what? Lines. So mostly the amount of line determine the country you are in. Mostly it is ranging between 6 to 13. Yeah, 6 to 13. So normally the amount of lines determine the country you are inside. So with perpetual inventory or universal product code, you will just see a code. Do you get it? So with this code, the organization, they have a way of taking the inventory. So you can see that whenever you buy your products and you go to the cashier to pay, you see that they will be scanning it. They will take one product, they will scan it, they will take the next one, they will scan it. So as they are scanning, one, they are calculating the amount of products you buy, the cost. Two, they are also taking inventory. Do you get it? So with this one, it is done electronically. They use computers to do it. So as we human beings, we can't do anything about it to value it. As they are scanning, then they are taking their inventory. Do you get it? So let's move on to the specific identification. Specific identification. So with specific identification, it is done this way. It is in the form of letters and numbers. It is in the form of letters and numbers. So whereby they code it in such a way that the employees are the only ones, or the CEOs and the employees are the only ones that they understand what it actually means. So you go to a company, for we the customers, we won't see it. But with the employees and the CEOs, the managers, they know what they mean. So they will have something like SABT. Then they will have under S, they will have something like 1, 2, 3, 4. You get it? So with this information, they have coded it in a way that only the CEOs, employees, and the managers, they only know how to they are the only one that can decode this information. Okay, so let's try and know how we can decode this kind of information and we can value our inventory. Okay, so let's take this example with a specific identification inventory. So let's take this example: INNOPYG. All right, so we have 1 here, 2, 3, 4, 5, 6, 7, 8, and 9. Okay, so now we are coming to learn how we can decode this information. So with this information, it will be given in this way. The product will be given, let's say water. Let's say water, okay, bottled water. The information will be given in such a way that they will decode using this information. They will code something using this information, whereby they can give it a specific code like AH. Do you get it? So AH, every employee, CEO, managers, they know how they can use this information to value our what? Inventory. Do you get it? So with AH, we just use what? They will give you the code in what? Letters. Whereby you have to what? They have to decode it using the numbers. Do you get it? So we know that A maps to what? 1. What about H? It maps to what? 2. This is how it's basically done. So with this one, you can actually say that, okay, then the price for 1 bottle of water is what? Let's say 0.12 what? cedis. Okay, so now let's take a proper example. I was just using this to explain it. Okay, so let's take a code of, let's say, NOP. NOP. Let's try and value this. Okay, so we know that with N, its map is what? 5. Okay, so we have 5 with NOP, right? Okay, we have 5. Okay, O, 6. Okay, P, 7. All right, so 5, 6, 7. And we know that normally in Ghana or in monetary terms, we don't have something like 5.1. It is normally 5.10. So normally with monetary terms, we always have what? 2 decimal what? Places. Do you get it? So you having something like this, you can't just conclude this. You have to find it what? 2 decimal places. So 1, 2. Okay, so now our final answer here will be what? 5.67 cedis. Let's take another example. Okay, let's take Jima. Let's try and see if we can decode Jima here. So let's say a product. We have coded a product in such a way that it is having the code of what? Jima. Okay, so Jima, we have G, Y, I, M, A, H. Let's try and see if we can decode what? This. You get it? Let's try and decode. So we know that G maps to what? 9, right? Okay, so G maps to what? 9. All right. So G maps to what? 9. Then we write our 9. What's next? Y. It maps to what? 8. 8. Okay. Then I. It maps to what? 3. 3. So firstly, you have to state your numbers before you find your decimal place. Okay. M maps to what? 4. All right. A. It maps to what? 1. Okay. Then we have H. It maps to what? 2. Okay, so monetary terms, we always have what? 2 decimal place. So let's find our decimal place. 1, 2. So our final answer for GMA, if we want to value that inventory, is what? 9834.12 cedis. You get a rationale behind it. So basically, this is how we use specific identification method. Normally, you can say SIM to value our inventory. And we can use the same thing to what? Find where we can find the actual position of what? The product. Do you get it? So with this one, we have something like slot, shelves, and what? Section. So always section comes first, shelf comes second, and slot. Okay, so let's try and decode this information. So with section, GMA, G starts from what? Maps to what? 9. So with this, let's try and locate the actual position of what? This product. Okay, so G, 9. So section 9. Which shelf? Y. 8. Shelf what? 8. Which slot? I. Slot what? 3. Okay, let's take another example. NOP. Okay, let's try and find the actual position of this product. So we have N. Which section? N here, we have what? Section what? 5. So section 5. Okay, which shelf? Shelf O. So shelf 6. And which slot? P. Slot what? 7. Okay, so this is all we can talk about using specific identification method, which is SIM. Let's move on to the next method. Now let's move on to another method or technique of valuing our what? Inventory. So we have something like what? FIFO. FIFO. Which means first in, first out. So first in, first out, what then do we mean? It means every product we brought in first into the business, every product that we brought into the business first, we must sell it first. That means first is coming in. It should be what is coming in to be first. It should be the same thing you are supposed to what? Sell. So what comes in first, you sell it first. So if a product comes in January, you have to sell it. Okay, let's say January, February, March. So every product you bring in January, let's say 10, 10, 20. So with this 20, you are supposed to sell this 20 first. You are supposed to sell, after selling the 20, then you move on 10, you move on to what? February. So you brought in 10 January, you sell it first before you what? Sell the subsequent ones. Okay, so now let's move on. So let's see, if you are selling this one first, that means you'll be left with what? February and March. So the February and March becomes your what? Inventory. That is what you are supposed to what? Value. So what comes in first, you sell. Before we started explaining the method, we said inventory is what, or the stock you are having at the end of what? Your accounting period, or at the end of what? A given year. So if you are selling this first, you'll be left with what? 20 and what? 30. And with the rule of what? FIFO, means if you are taking in inventory or you are valuing your inventory, you start valuing it from what? Down. Then you move upwards. So with FIFO, you will start valuing your inventory from the down, then you move what? Upward. Take it very serious, or else you get confused. So we will start valuing our inventory using the FIFO from the down, then we move upward. Okay, so that's basically the rationale behind what? Our FIFO. Let's take an example and try our hands on it. Solve or value our inventory using FIFO with the table given. Okay, so we have what? our ending what? Inventory. Our ending inventory. That means what we are left after selling. What we are left after selling. So let's try and value our inventory. And we set our rule for FIFO. If you are valuing your inventory, you start from where? The down and move upward. We start from the down and move upward. And here's the case that we have our inventory to be what? 89. So let's try and value our inventory. You could see that with the ending inventory, we are not having any price for it. Okay. So let's try and value our inventory. So we value from the down to the top. So we start from what? October. So with October is going to take how much of our inventory? 40. Okay. So 40. So our net inventory becomes what? 89 minus what? 40. We are left with what? 49. So we will take this 49 to the what? Preceding what? Month, which is July. Okay. So let's try and value our what? 40 here. Let's try and value our what? 40 here. With our rule, we start valuing our inventory from what? The down to the top. Down to the top. So what then do we start with? We start with what? October. Okay, so October. What are we having? So the 40 here means, the 75 here means, per every item here, it costs what? 75. So one of the 40 will cost what? 75. So what then is our total for the 40? Okay, so we having what? 40 times what? 75, which will give us 3,000. So this is the inventory valuation for only October. But yet still we are left with what? 49 inventory. So we have to move it to the next month. So with the next month we are having what? July. So let's value our inventory. So we could see that with July we are having what? 60. And our inventory here is left with what? 49. So July can only take what? 49 of our inventory. It can't take what? 60, because we are left with only what? 49. So July will take what? Only 49. You can't say 60 because our inventory is left with 49. What is the price there? 85. So times what? 85. It will give us 4,165. 4,165 cedis. All right. So now we have our inventory valuation for what? July as well. What then do? We have to what? Sum them up. So our inventory. So inventory valuation for 89 of our what? Products will be what? 3,000 plus what? 4,165. So we'll be getting 7,165. 7,165. So this is how we go about what? The FIFO. We said the FIFO, we start value our inventory from what? The down to the top, whereby we were giving our ending inventory to be what? 89. So 89, when we start value this 89, October will take what? 40 from the 89, and we left with what? 49. So the 40 we have to value it, whereby we said 70 is the price for each product here. So we will multiply the 40 by 70, whereby we had what? 3,000 here. Then we move on to what? The next or preceding month, whereby the preceding month is what? July. July 2 will only take what? 49 of our inventory because our inventory is left with only what? 49. So 49 each will cost what? 85. So 49 times 85 will give you our total valuation for what? The 49. All right. That's 4,165. Then we multiply, we get what? 4,169. 65. Then we add them to get our total inventory valuation for the 89 what? Units of our products. Okay, so now let's move on to the next method. Okay, so let's continue with what? LIFO. LIFO. So with LIFO here, it means the last product you bought, you have to what? Sell it first. The last product you bought, you have to what? Sell it first. So if we are selling our last product, here, what's our last product that we brought? What's the month? October, right? So meaning we have to sell October 1st before we sell what? July. So we sell using the LIFO. We sell from down to top. So if we are selling from down to top, that means our inventory will be left with what? Those at the top. So with the LIFO, the rule here is that when you are taking your inventory or you are valuing your inventory, you start from the what? The top to down. So you start from here, then you value it downwards. LIFO, you start valuing your inventory from top to down. LIFO, you start valuing your inventory from what? Top to down. All right, so let's use this table to try and value our inventory. So we have our ending inventory to be what? 110. So we have what? 110. Let's try and see if you can value this what? Inventory. Whereby we said we value it from what? The top to down. Okay, so we will start with what? Our what? Beginning inventory. All right. So with our beginning inventory, we have what? Only what? 20 units. 20 units. So which means beginning inventory will take only what? 20 from our what? Inventory. So we have what? Our what? Net inventory to be what? 110 minus what? 20. We'll be left with what? 90. So which means we will send this 90 to what? The preceding what? Month, which is what? January. All right. So let's value our what? Beginning inventory. Whereby we had what? 20. Okay, 20 units. So 20 times what? 70. 20 times 70 will give us what? 1,400. All right. 1,400 cedis. Okay, that's for what? Our beginning inventory. Let's move on. January. We said we value our inventory from the top to what? The down. So we are done with beginning. Let's move on to what? January. So January is going to take what? 50. 50. All right. So when you less 50 from our net worth inventory, we will get what? 40. So we will take this 40 to the preceding what? Month, which is what? March. Okay, now let's value our January. So January will be what? 50 times what? 80, right? 50 times what? 80. We'll be getting what? 4,000, all right. 4,000. So that's what? Inventory valuation for what? January. We are left with what? 40. So let's move our 40 to what? The preceding month. So when we move, we will go to what? March. So March will only take what? 40. It is taking 40 because our inventory is only left with what? 40. So March, all right. So March 40 times the price, 90. 40 times what? 90, which means you are getting what? 3,600, right? Yeah, 3,600. 3,600. So this is our inventory for what? Inventory valuation for March. What then do? We have to sum everything up to get our total inventory valuation. So our inventory valuation for 10 units is 1,400 plus 4,000 plus 3,600. What are we getting? We are getting what? 9,000. Okay. 9,000. So this is our inventory valuation for what? 110 units of products. So basically, this is the rationale behind our TLIFO. You will start valuing your inventory from what? The top to the down. Start valuing your inventory from what? The top to the down. All right. So let's move on to the next method. Let's move on to what? Gross profits method. Gross profit method. So with gross profit method, it's formula way. Whereby you have the formula to be what? Merchandise available for sale minus what? Cost of what? Goods sold. Cost of goods sold. Whereby we have, so this is what? Gross profit method. Whereby our merchandise available for sale is equal to what? Our beginning inventory plus purchases at cost. Beginning inventory plus purchases at cost. So that's our formula for what? Merchandise available for what? Sale. Merchandise available for sale. Okay. So then, how then do we calculate our cost of goods sale? What cost of goods sold? Cost of goods sold. So our cost of goods so is equal to our sales or our net sales minus our markup. How do we find our markup then? Take note of the formulas. So markup is equal to markup rate times net sale. Take note of these formulas. We'll be using these levels. Okay, or we'll be using levels. So now let's try and take our first example. Alright. Okay, so let's take this example. Inventory on August 31st was 24,200. During the next 4 months, the company had purchases of 42,500 and net sales of 52,800. Using the gross profit method to estimate the value of inventory on October 31st, if the company uses a markup of what 25 on selling price. So with this, we know our what formula for what inventory using the gross stock, which is our merchandise available for what sale minus our what cost of what cost of goods sold. All right, so we know our merchandise available for sale is our what our beginning inventory plus what purchases beginning inventory plus what purchases. So we know our beginning inventory to be what, so MAS, beginning inventory plus what purchases. So beginning inventory here is what 24,200. all right, 24,200. What is our purchases? We had a purchases of what 42,500. 42,500. 42,500. All right, so 42,000, when you add them, we are getting our merchandise available for what sale to be what 66,700. so 66,700. all right, let's find our what cost of goods sold. So our cost of goods sold, we know our cost of goods sold is what C is equal to what net sales minus what markup. Markup is equal to markup rate times net sale. All right, so let's first find our what our markup. So our markup, all right, so we're given our what rate to be what 20.5% divided by 100, we are getting what 0.25. 0.25. what's our rate? Our sales, our rate is what 0.25 times 52,000 what 800. 52800. we are getting what 13,000 what 200. 13,000 what 200. So let's subtract this from our what sale. All right, so our sale is what, so cost of goods sold is equal to what, our sale is what 52,800 minus 13,200, and we are getting what our cost of what sales to be what cost of goods sold to be 39,600. 39,000 what 600. So we have what 39,600. Let's substitute it into our what formula. All right, 39,600. 39,600. So our cost of merchandise available for sale was what 66,700, right? So with gross profit 66,700 minus our what 39,600. 39,600, and we are getting something to be 27,100. 27,100. 27,100. So basically, this is how we value our inventory using what the gross profits, whereby you'll be given what a rate. The rate you have to what multiply it by your what, multiply your rate by your what net sales. After multiplying, you subtract what you had from your what net sales to get your what cost of goods what sold. So getting your cost of goods sold, we have to subtract it from your what merchandise available for what sale. You subtract, we are getting what 27,000 and what 100. Let's move on to the next method. Okay, so let's move on to weighted average. Weighted average. Okay, weighted average. So We all know about average. So let's try and understand something here. So 1, 2, 3. Let's try and see if you can find average here. So average here means the total sum, or let's say we will sum everything. So sum over total number of data. Okay. So here 1 plus 2 is what? 3, right? 3 plus what? 3 is what? 6. So it will be what? 6. What is the total number of data you are having here? 1, 2, 3, right? So 3. This goes here 1 time, itself 1, 6, 2 times. So the average for this data is what? 2. So that's basically we mean when we talk about what? Average. So now let's try and value our inventory using what? Weighted average. Okay. Okay, so let's try and use this table here to try if you can value our inventory using what? The weighted what? Average. The weighted average. The weighted what? Average. So with this example, let's say after we selling everything, we're left with our inventory to be what? 68. So let's say our what? Inventory 68. You get it? So let's try and value our inventory here. So we said weighted average is the sum of what? What you are having divided by the total number of what? Product or what? Data you are having. Okay. So here, this is our what? Product. Then we have to find our what? Price for each what? Product. Whereby we were given 30 to be the price for what? Each product. So we have what? 60 pencils here at the beginning of inventory. So this 30 here doesn't mean that 60 cost what? 30. It means that 30 for every or each pencil, it's cost what? 30. So we have to find the price, the total price for what? This 60 pencils. Okay, so let's try and create another column for this data or our table. So if you multiply 60 by 30, you are getting what? 1,800. 1,800. So 1,800. So 1,800 becomes our what? Amount for what? The 60 pencils. Let's move on. We multiply our 80 pencils by what? 180 pencil by what? Our 80. So let's note here, this is in monetary what? 10. This is in monetary term. Okay. So when you multiply, you are getting 14,400. 14,400. Okay. Let's move on. 30 by what? 70. When you multiply, you are getting 2,100. So 2,000 and what? 100. All right. So with our weighted what? Average or our weighted average method, we have a formula for it, which is what? The total cost of the product divided by what? The number of units. So we have total cost of product, all divided by what? Then total number of units. All right. So this is our total cost for what? Beginning entry. This is our total cost for January. This is our total cost for what? February. So then, what then is our total cost for everything here? Okay, so total. Total. So let's first sum our what? Our units. So total what? Unit becomes what? Okay. Let's first sum our what? Total what? Unit. So this is what? In unit, and this is in what? Monetary term. So our total unit becomes what? 200 and what? 70. 270. 270. When you sum it up, you are getting 270. What is our total what? cost for the product. So 1,800, 14,400, 2,000, and 100. Okay, when you sum, you are getting 18,300. So 18,300. What then is our formula? Total cost of our product over what? Our total what? Units. So this is in what? Units. All right. So note, okay, always it will be given in a form, in a table form like this, and you have to know what you are supposed to do. So now let's substitute our totals in our formula. So 18,300 divided by 270. So you are getting 67 cedis point 78. So 67.78. So this is our what? Our weighted average for our table. So now we have to value our inventory. Where we said our inventory here is what? Our 68. So just multiply our what? Inventory by our what? Weighted average. So inventory valuation will be equal to weighted average times our what? Inventory. So we will be having 68 cedis 0.78 times what? 68. What are we getting then? We are getting 4,609. 4,609.04. So this becomes our what? Valuation of this inventory. So we have valued the 68 units of what? Our inventory.
Thank you very much. This brings us to the end of this section, inventory. Our next section will be on turnover to aid us complete the whole section on inventory and turnover. If you have any question, kindly drop it in the comment section. My name is Jima Ade Samuel, GAS for short.